Well, hello there. Carol Dockum here with Beautiful Faces Going Places Women's Success Network. Um, yeah, we are recording. Awesome. I just had to double check my buttons here and we are recording. Yay. So thank you so much for joining us for our mini masterclass series that we offer here at Beautiful Faces Going Places Women's Success Network. We are all about creating opportunities for our members and our viewers, all about visibility, education, connections, and yes, fun. We host all kinds of amazing events online and in person. And Mini Masterclass series is just one of them. We value education here as solopreneurs, entrepreneurs, small business owners. I truly believe that sometimes it can be a lonely place in space. And sometimes we don't know what we don't know, right? We don't have all the answers, but guess what? We have experts that do, which is why I'm so excited about today's mini masterclass series. I am going to introduce to you our host and speaker, presenter, facilitator, Deborah Daniels. She is a CPA and money expert. Deborah brings over 3 decades of experience as the founder and CEO of Charter Accounting Tax Service, a CPA firm based out of Atlanta, Georgia, with clients all over the country. Deborah brings a unique blend of financial expertise, real-world authority, and practicality to help her clients really understand and master the whole money equation. Her goal is to help her clients make more money, keep more money, and grow more money. Through her platform, womenswealthsecrets.com. She covers all of the money and financial aspects of both business and personal finance, from teaching individuals financial confidence up to helping her small and medium-sized business clients scale past 7 figures. I don't know who's interested in that, but I am. Deborah is a speaker, author of 100 Innovative Ways to Make More Profit, and soon to be released Women's Wealth Secrets, and the host of the podcast show, Money Without Limits. Deborah's goal is to change the money conversation, especially for women, us, to support her belief that when one of us prospers, all of us prosper. So please help me welcome the fabulous Deborah Daniels.
Awesome. Thank you so much, Carol.
You're
I
welcome.
love to be in this population. I love the group. I've spoken for you other times in person and virtually, and I'm glad to share what I think is some pretty timely information. And you are right. I'm going to share my screen here. Don't judge my money knowledge by my tech because it's not the same. I'm trying to find it on here. Let's see. Let me see. I might have to do that. Let me see. Sorry. I know I had them ready, but of course that doesn't work for me usually. But
It's all
okay.
good.
Okay, let me find this slideshow and from beginning. Okay. Can you see it? No, not yet. I guess I have to get it on there first before it starts playing. Share a screen, share the whole screen, and then I think this is gonna work. There. Yes. Yes. Oh, actually, I actually did it. I have some slides from when I did this before. It's part of this, but so anyway, we're going to talk about 2025 tax planning and why it's so important, what you can actually do that will make a huge difference in your money and in your wealth. I do talk a lot about make more, which is kind of how do you get the revenue in, the cash register ring. Then the keep more is really this. I 100% believe that saving on taxes is your biggest expense for most of us. And I do talk a little bit about operations and some other leaks, but let's take care of the big stuff first, right? Which is, I think, is the taxes. And then the grow more money really is now that we've made it, now that we've kept it as much as we can, how can we take that money and multiply it? For generational wealth, for really a legacy that we can provide, because it's not just about what we're doing today. I'm not going to go into my background because basically Carol gave you a good overview of that. But this kind of what leads me a little bit is this quote from Robert Kiyosaki. It's not about how much money you make, but how much money you keep and how hard it works for you and how many generations you keep it for. I mean, so that just really sums up. I mean, I already had the make more, keep more, grow more thing kind of as my, what I was really all about. But then I saw this as, oh my gosh, I'm thinking like Robert Kiyosaki, so I must be on the right page, right? But how do you really keep more of what you make? I firmly believe that it's tax strategy is the first place to go. I mean, obviously, I'm a big proponent of just the whole money equation. I don't like to, tell people, oh, eat ramen noodles, turn off your lights, cancel your Netflix subscription. Those are so little. If you could work on your business and the money that's coming in and saving more taxes from your business, you could have 1 million online subscriptions. So let's not go from the thought of lack of what can I cut out, but what can I really do so that I have more money to do everything I want to do. And I do think 100% that tax strategy is one of the ways to go on that. So let me get this all out here for you. Okay. So really, this is key. This is, I think, where really people leak the most money on taxes. They are looking at it from the wrong perspective. There's two pieces to the tax process. There's the preparation, which is what you see, whether you use me or any other CPA, or you do your own tax return or your H&R Block guy or whatever. You are, seeing them, January, February, March, April. Unfortunately, some now I'm starting to see the extension season. So some people wait all the way until August, September, October to do that. That's backwards looking. That's a historical document. We're just putting everything down on the forms, and it's too late to do anything about it. So what do you do to avoid that? To me, the tax planning. Right now, I'm spending most of my time, my team is working on the 2024 extensions. I'm spending most of my time working with my clients on, okay, we're 8 months through the year. What should we be doing? What do we need to change so that we can really affect that tax bill next spring when it's time to file our taxes? And we have to do some of those things. When December 31st hits, bonus depreciation on equipment that you bought, you can't do it in January. You'll have to wait till 2026 to get it. You can't do certain few little retirement things you could do after the end of the year, but there's a lot of stuff you have to do and have to have in place before December 31st to make a difference in this year's tax bill. So if you get nothing else from what I'm saying, you have to, you don't live your life without some kind of, I don't like the word budget, I call it money plan, because then I'm more in control of what I'm doing instead of being restricted. But if you don't run your business without some idea of how am I going to raise revenue, what is my budget? How much am I going to spend on telephone? How much am I going to spend on, subcontractors? This should be a profit center of your business. It should get as much attention as how you're going to bring the revenue in, because it's going to make the biggest difference in how much money you have at the end of the year. Let's put this in here. So there's a lot of different ways you could look at tax planning. How do you maximize deductions, and what are those? And there are a treasure trove for us as business owners. We are, even before the new tax law, we were kind of the winners, because the reality is, if most of your income is coming from a W-2, there's most of the provisions in the tax law don't really impact those folks. It's really, how do you take expenses that you were already going to spend and make them somehow tax deductible? Using business use of home as a solopreneur, your cell phone, if you're using it for business, some of your meals, don't just go have a meal so that you can deduct it. But if you're having a business meeting, why not put that on your business expenses? Huge one that people miss on a lot is the structure. If you are a solopreneur and you're just getting everything to your social security number, or even if you're an LLC and you're still having it taxed to you personally, that can cost you a lot of money. Now, it doesn't make sense to do some of the things you need to do to save on that, which is become an S corp and, pay yourself a payroll and things like that, until you get what I call like the minimum area, somewhere around $50,000 or $60,000, $70,000 of profit. But it doesn't take very much to get to that level. And once you do, these are some juicy write-offs that you can do. And then also, we're not just working for today to pay our, bills, our mortgage for this month. We're in business because guess what? Nobody else is looking out for us. If we're working for ourselves, we've got to worry about our, what are we doing for pension, or what are we doing for retirement? And there are some plans that are better than others, some that fit into the right tax box. And then also, what I love is, how can you move income among family members so that the family pays less in tax? And what I'm talking about there, and we're going to talk about a little bit more, is shifting income to your children, to your parents, if you're helping support them. How do you do that so that the family comes out the best, right? And so let's put this in. Okay, let's talk about this. So timing sometimes is really what's important. This is even, I mean, there's a lot of stuff going on with charitable. Charitable, you can only do if you itemize. But as you'll see later, when I give you a couple of the highlights of the new tax law, there's actually going to be what's called an above the line deduction for some charity. So say you don't have a mortgage anymore, or you don't have enough to take advantage of the much bigger standard deductions that I'm going to tell you about towards the end of the presentation. You actually can, even without itemizing, starting next year, are going to be taking, I forgot, I have to look at the slide. It's either 500 or 1,000 of charitable, even if you don't itemize, which is huge. They did that during the pandemic, but then they took it back away from us. And then like medical has to be over a certain percentage of your income. So if you cluster those together from one year to the next, or also the charitable. So say you don't have enough, but you're almost to enough to be able to itemize, instead of, you could go ahead in December and make your charitable contribution to some of the things you were going to do in 2026, pull them into 2025, and just don't, I mean, you're still giving, if you were going to give your church an extra 5,000, they don't care if you give it to them in December or $400 a month as throughout the year. But just strategically taking what you were already going to do and making it fit into a tax favored basket, right? I don't know the ages of people that might be listening to this, but one of the things that people that are already in retirement can do is to do, it's called qualified charitable distributions. You can take money from your retirement account, have it donated directly to your church, and how that benefits you, even if you can't itemize, is now, instead of if you took $5,000 out of your IRA or 401k, whatever retirement vehicle you have, that's taxable to you 100%, unless it's a Roth. So if you wanted to give 5,000 to your church, or your pets, or whatever, the arts, whatever your charity of choice is, you can actually take it from your retirement account, donate it, and it never shows up on your tax return as taxable. So just another way to live your life. I'm not saying change your life to fit the tax code, but live your life in a way that saves you money on taxes. So basically that $5,000 contribution only costs you $5,000. If you can't deduct it, 5,000 means you have to make about 7,500 to donate that 5,000 to your church, right? So just how do you do it if you can't get rid of the taxes, how do you do it with the cheaper tax? Does that make sense? Let me just tell you. And so this is a whole, I could do a whole mini masterclass on just the difference between Roth and regular and what the strategies are for that. And I certainly could do that if Carol wants us to do it. But one thing that people don't really realize is there's a lifetime tax to some of the costs that we're doing. And we have to keep that in mind a little bit. Saving money today doesn't always make sense for in the future, because I mean, obviously if we could get tax-free money, that's great. There's ways to do that. There's, if you proceeds from a life insurance policy are tax-free, certain grants and things like that are tax-free. It's hard to get in the tax-free one. But taxable, there's so many different ways. That's wages, that's income from your business, that's interest, dividends, capital gains from investments, and there's different rates for that. So how do we skew our income to fit into the lowest of those buckets if we're going to pay tax on it? Or if we can get it tax-free, that's even better. But and the tax-free that I really like is Roth distributions. So like, let me just explain really quickly on that for people that don't understand about Roth. Roth is still a retirement, just like an IRA. And I think don't quote me on the exact number, because the number that I can look up, I don't have right in front of me, but around $8,000 if you're over 50, 8,000 or 8,500, you can contribute to an IRA every year. Well, you can also do that into a Roth. Some of us, if our business is successful or our spouse maybe makes so much that we can't do it, can't even contribute to a Roth. But if you can contribute to a Roth, there's no deduction today. So we don't get a 2025 deduction at all. But say that 8,500, I do that every year, no tax benefit, no tax benefit, no tax benefit. But that 8,500 grows into be $500,000 when I'm in retirement. All that money comes out with no tax. So if your neighbor was doing a 401k or doing a taxable IRA that they got benefit during the year, like they'll get a benefit this year. They have 500,000 in a taxable IRA. You have $500,000 in a Roth IRA. That means that you in the Roth have potentially 35% more money saved because you're going to take that money out with no tax. Your neighbor's going to have to take it out and pay tax on every dollar that comes out. So I'm saying it's not just the tax, but the timing of the tax. And then, of course, tax deferred are those kind of ones like the IRAs, like your neighbor would be pulling it out. They push the taxes out. They got a little benefit today, but somebody that has 500,000 when they're 70 probably only put in 100 or $200,000. They did get a tax benefit on that, but then all the rest of it they're going to pay taxes on. And this whole idea that we were kind of sold and why this was built on it, that we would pay less tax when we're in retirement, is just I do over 1,000 tax returns a year. It's just not happening. Most people are still in the same or just a slightly lower tax bracket than they were when they were working because they don't want to change their lifestyle. They don't want to go from making $300,000 a year to 50,000. I mean, so it's kind of a fallacy that we've been sold to do the save taxes today to not pay it in the future. So there's a lot of strategies of how to get that money into Roth, and converting is a great strategy. And that's something I spend a lot of time with clients at this time of year, like figuring out, can we convert some of this? I mean, my husband and I have been converting for the past 10 years. I mean, I'm not even close to early retirement yet because we would rather pay the tax now and let it grow, now while we're making money, and let it grow so that when we're not making money, we could take it out at a cheaper rate. So that's a whole nother topic we could spend 2 hours on just by itself. But I did feel like it was important to stress that just a little bit. But really, to me, this is the gold. This is the gold for people that are entrepreneurs, business owners, solopreneurs, if you have children. It's good all the way up through, really when they're not making money. And honestly, I see a lot of clients whose kids are still in their mid-20s that are still kind of dependent on their parents. But the reason this makes sense is even when your kids are little, if you pay them, and I'll tell you some of the things you have to do to make sure this works. But so anybody, your child is 0 up to 100 years old, which I'm hoping to live to be that long. If you're a single person and you only have $15,750 of income, that's the new higher standard deduction from the new law. As a single person, you get that for 0. So if I'm a business owner and I'm making, let's just use an easy example, $100,000 of profit that is going to be, then you're in about the 25% bracket. So that 100,000, I'm paying, if I can move 15,750, so let's just say 16 to make it easier for the math for me. So instead of paying on that tax at my level, that 15,000 I pay to my child. They have money. And I'll explain why this isn't, you're just not giving money to your kids. That saves me 15,750 off of my business profit and loss. I've paid my child 15,750. That saves me almost $4,000 as a family for that same money. Now, I don't know about you, but my kids were very expensive. They had dance class. They had, competition level sports. They had after school activities. They wanted a car when they turned 16. So you're not just giving them the money. You're kind of putting it to the side to use for the things you were going to spend anyway, right? And I do think it's kind of, I don't care when I tell clients this strategy. I give them this is what you need. Here's some job descriptions. This is what we need to tell. Keep timesheets, all this. I don't really care if clients are really making their kids do the work. I think it is good for them to learn about money and saving money and things like that. But it is a strategy to take money that you were already making in your business to pay for things that you were already going to pay at a much cheaper rate. And this doesn't even take in what that $4,000 I said, doesn't even take into account the state income tax that you're saving, which would be another 5% of this. Be another like $300 in Georgia, right? And in Ohio, I can't remember what the state income tax is there. But you see how it's the same thing, the same activities, but just using the money more efficiently. Oh, yeah, exactly. So depending on the tax rate, if you're in a lower bracket yourself, even at the lowest bracket, it's saving you $1,575 all the way up to almost $6,000, including depending on your tax rate. I love that. It's 100% one of my favorite tax write-offs. But here's a couple of others. Obviously, any of us can, as self-employed people, write off 100% of our self-employed health insurance, for sure. There's also other ways we can structure you. And sometimes it means having a couple of different layers of entities. And that's why sometimes you really need someone like me to kind of help you, because it's not like just check a box and do it. But the thing is, every time that I sit down with a client and we come up with a plan of trying to take advantage of these things, the extra administrative time for themselves of paperwork they got to fill out and or cost of having additional returns or payroll or things like that. I mean, we look at that. If it doesn't make sense, you don't do it. But if you're, especially what I call kind of almost the minimum, I call it the minimum self-employed income. I mean, because honestly, if not, go work for somebody else. But if you're making $100,000 or $120,000 net in your business, this saves you 10, 15, $20,000 if depending on which of the strategies you implement. So for maybe an extra $1,000 or $2,000 of administrative cost, I mean, that's a pretty good return. I don't know very many investments that I could put $2,000 in and get 20,000, guaranteed year after year after year. One of the ones I really love is renting your home to your business 100% tax-free. That's not talking about home office, which of course we can do, and there are some strategies on that. But this is a thing, if you've ever heard anybody talk about what's called the Augusta rule. It's called the Augusta rule because it was originally set up because of the Masters here in Georgia in Augusta that they had every year. There's not a lot of hotels around Augusta, so people would leave and rent their homes out for people to come and watch the Masters. And they made a rule so that it would incent people basically to do things like that. You could also do this with your vacation property. Your own home, though, you can use up to 14 days. If you go over 14 days, this is a bust. But so say I want charter accounting to rent Ed and Deb's, my husband and I's house for a sales meeting, for a customer appreciation thing, for a VIP day or whatever. The company deducts that the rent, pays rent to Ed and Deb, and then Ed and Deb don't have to include that in their income as long as it's under 14 days. And there's all kinds of, I've got checklists for that as well, like what's a fair amount of rent. And, again, all these things have rules. They're meant to help us take advantage of the tax laws, not punitive. I mean, the whole code is written with rule after, I don't like loopholes because there are no loopholes. It's called know the rules of the game, structure yourself and do things that you're already doing in a way that gets you to take advantage of these things, right? And then going back to saving on the right structure, very different tax between the 1099 person straight to their social, LLC, S Corp, sometimes a C Corp, not our population too much that it makes sense to have a C Corp, but sometimes it makes sense to have a little management company that's a C Corp to take advantage of some benefits that we can do that way. Same money, different entity to do those things, but we're getting to take advantage of all those rules, right? Let's see what else. There's credits. Okay. So there right now, and this one thing I didn't check on that I wanted to check on before I jumped on this. There's a lot of energy credits that are good through the end of this year that, if you need a new air conditioner, if you need more energy efficient windows, we had a door that we just replaced. It was more energy efficient. You can really get a lot of tax benefit from that. So you want to know when those deadlines are. That became a lot juicier, actually, not even in this tax law change, but the one before. It used to be that you only got to do that for like $1,500 for your whole life. I don't know. I spend more than that in my house for sure on doing those kind of things. Now it's $1,500 a year. So it does make it a little bit more cost effective to do some of those home improvements that are going to save you money also in cheaper energy costs, right? And then making those smarter investment decisions. And part of that is, like I'm saying, what kind of vehicle are you putting it into, that both retirement type or regular? Because some things give you things that are taxed at capital gains rates. Other things are taxed at ordinary rates. The difference being there is ordinary rates are like wages, business income, short-term capital gains, ordinary dividends. Those can be as high as 39% in tax. Capital gains, on the other hand, are a maximum of 20%. So how do we get our money to fit into that bucket? So a lot of it's deciding on what types of investments to be in, right? That's why, if you remember back, I remember one presidential debate, I think it was way back, Romney and Obama, but they were kind of arguing on the during the debate about who paid the least amount in tax. It's because most of their money was in capital gains. And you've heard Warren Buffett say before that or Sam, I think it was Warren Buffett, that he pays less than his assistant, or it was Sam Walton or somebody, that he pays less in tax, maybe less percentage wise, but certainly not less numerically, but it's because it's the right kind of income. And you can definitely figure that. I mean, you can definitely manage those kind of things. So now let's talk a little bit about the tax law change. It was signed on July the 4th. Congress passed it right before they all headed home for 4th of July. And I think President Trump signed it on the 4th of July. The tax brackets that we got in the 2017 tax law, which was the biggest tax law change really that I had seen in the 30 years I'd been doing taxes, and was when President Trump was in office the first time. Those are permanent. They were set to expire at the end of the year. The thing that's key about that, as business owners, probably not as much our size of business owners, but those bigger businesses that are making, more long-term projections, it's given us some certainty of what it's going to look like. Everything was, really, you didn't know what was going to happen January 1st as far as the taxability. And if somehow the tax rates jumped from 37% to 50%, which, at one point they were as high as 95% in tax on the highest amount of income, that makes a big difference in how you're going to run your business and how businesses that sell things to us are going to run their business. So having that permanent, not permanent until they do another tax law, but it's not expiring in January. So we do have a little bit of permanence in that I'm sure over the next 3 or 4 years, we won't see a rate change. So that gives us some little bit more midterm confidence in making our business decisions, because really it is all about knowing what's going on and making those decisions a little bit. There were some pretty big standard deduction increases. Like I said, that $15,750 that I was talking about, that was only $15,000 before this new tax law change. So they increased the single by $750. They increased the head of household by $1,125, and then married filing jointly went up by $1,500. So more people are still going to be able to take the standard versus the itemized, and at a bigger level. And if you think about that $1,500, even for somebody in the 10% bracket, that just saved an extra $150, right? Because the lowest bracket is 10%. So, I mean, everyone will be impacted by these changes. But then there are the real winners. And I don't know if I talked about this too much in this. I know I'm talking about this in depth in my webinar that I'm doing at 2:00. But the seniors actually are getting an extra so if they're married filing jointly, their standard deduction just went up by $1,500. But then they get an extra $6,000 for each spouse. So if you're single, it's only $6,000. But if both you and your spouse are over 65, you get $12,000. So it's like some crazy high number, like $43,000. If you make $43,000 or less, you pay zero in tax, which is huge for our seniors. I mean, I think that's absolutely amazing. Of course, it's not helping our tax does have a little bit of a punitive on those of us that are super successful. So if you get over a certain amount of income, it does start phasing out. But then for almost everybody, the child tax credit, that's only for kids that are under 17, has gone up to $2,200 per child, which was only $2,000 before. Again, just more extra money for us to spend on other things. This is huge. And I don't know, it depends on, what your type of business is, but tips up to $25,000 per year are now tax-free. So if you own a hair salon and you're getting tips from your customers, the tip part up to $25,000 is zero tax. Or if you are like our servers, a massage worker, anybody that gets tips, $25,000 of tips per year is tax-free. Again, remember those rates, 10% to 39%, that's a minimum of $2,500 extra in somebody's pocket who made $25,000 in tips. Again, just more money in our pocket to try to stimulate the economy. And if people understand the whole cycle of money, it makes sense when they're encouraging us, they're giving us money to spend. That means me as a business owner, I now can pay someone for my daughter's dance classes. Then that dance teacher can then buy whatever she wants to buy. If there's really a ripple effect on us spending. And when the government, for whatever, I mean, the law really does encourage different types of behavior. When they give us reasons to spend more, it just benefits us all. And then another one, this is crazy, and I still am not sure how people are going to track this. I guess we're going to have a special W-2, special box on our W-2. Overtime up to $25,000 is not going to be deducted. So on your W-2, it's probably going to say, if you get a W-2, it's going to say wages, 40,000, overtime in a separate box, 25, and that 25 won't carry over onto the tax return. I mean, they haven't, they've just signed this, what, a month ago? So they're still giving us guidance on how that's going to be reported, but it will be segregated and not taxed at all. Huge. I mean, never before have I seen something in 3 decades like that. There are a couple other things that are really cool. The student loan forgiveness potentially can be tax-free because there's a lot of I see a lot of that come through here that people don't realize when you walk away from your student loan, that's actually income to you. And it does make it a little bit less beneficial to walk away from that. So I guess, but they're saying if you die, your heirs aren't going to be responsible for it, which I'm not sure they were before. But if you get disabled, you can forgive some of that. This one is huge. If you've ever heard the term SALT, state and local income taxes. That means property taxes, your state withholding that you pay to your state. Here in Georgia, we have a tax, it's called ad valorem tax when we buy a car. We maybe, pay a percentage of the cost of the car. All those things, tags, anything like that, that used to be was limited for the past several years to $10,000. Well, my property taxes are almost that much. So all my other taxes were, so now it's up to $40,000, which is huge. And so a lot of people that weren't itemizing over the past several years will be able to itemize again. So then all of a sudden those charitable dollars that most people are going to do, whether they get the deduction or not, are going to be more valuable, right? But here's a little bit of a loss on this. The electric vehicle credits that have been in place, are going to go away as of September 30th of this year. So if you want to get an electric vehicle, you better jump on it now because those credits are going to waste. And actually, my husband just bought a new electric vehicle just partially because of that. But and then there is for those of us that have participated in adoption. I have not, but my sister-in-law did. Some of those fees could be refundable. Before it could offset tax that you had, but refundable means if you ended up with zero tax without it, you could actually get that $5,000 back. Super, super valuable. This one is crazy. I've never heard of such a thing in my life. There's these new things called Trump accounts. And they are for any children born between 2025 and 2028. So if you're like me, a little too old to be having kids, could potentially benefit my grandkids, but they are actually going to fund $1,000 when these children are born into these accounts. And then we can make annual contributions up to $5,000. And that grows tax-free, kind of like an IRA, and they can start taking them out at age 18 to use for, college or career training or buying a house or whatever. But that's just, it's just trying to get our young people, in that saving earlier because it's kind of, I know when I was growing up, everybody, I remember my grandparents talking about save, 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 save. You don't ever hear that messaging really anymore. So hopefully this will have that benefit. Again, tax law benefit, influencing our behavior. And then a couple of different things that are coming on the pipeline, because here we are 4 months before 2026. We need to be kind of thinking of that. I talked about the donations that I couldn't remember the number, but for single, it's 1,000, 2,000 for married filing jointly. That means even if you don't have enough to itemize, you can still take off some charitable. And they are going to, they're gonna kind of like medical. You have to have 7.5% of your income to be deductible. They're kind of doing that to charity now. It's only 0.5%. So that means if your income's $100,000, only the charitable in excess of 500 is going to be deductible. But guess what? You get to take it on the front 1,000 or 2,000. So we're really not losing anything. They just don't want to let us double dip. Does that make sense? This is a new one that's been gone for a little while. If you buy a house and you have, you don't put enough down, they make you buy mortgage insurance. That's now deductible again. That's been gone for 5, 7, 10. It's been gone for a while. And then this is a new one, kind of interesting. If you like to gamble or go to the casino or play the lottery every day, that income is taxable to you if you win. In the past, you could offset it with your gambling losses. Now they're saying, hey, you can offset it, but only 90%. So if you make 10,000, you could only deduct 9,000 of betting or buying tickets or whatever. So you would still have to pay tax on 10% of the earnings. That's fair. I'm not upset with that. And then as far as itemized deductions, now that most of us are going to be able to itemize again, they're saying you can't have more than 35% of your income offset by itemized deductions. So if you have $100,000, you can't have more than 35% of your tax benefit. It's a little more complicated than that, but it just means if you're making a whole lot, they're not going to let you just pay zero, which I'm okay with too, but don't make me pay extra. And so I'm not sure I want to waste time too much. We'll do a little bit on this. So in addition to taxes, which I've already told you is the absolute best way to save, to create wealth, create cash flow or whatever, I think it's the best one. But I just threw up here a little bit of other things that I see people kind of, leaking money out or whatever. And if you want to take a screenshot of that, I mean, obviously they're just different things. There's no really explanation of what they are, but those are some of the places I see people. Retail therapy, that's when you go and just buy stuff just because it makes you feel better. I mean, buy whatever you need, but don't use it as just as an entertainment. And so I want to just give you a couple of ways that I can help you. If you go to deborah.daniel.com/resources, that's a page that I keep up all the time that has like the most current webinar that's on there today too. I also have an audit guide on there that tells you how to keep yourself audit proof, because if you're taking advantage of all these things, you want to make sure you're documenting what you need to document to, make sure that if you do get audited, you're bulletproof, basically. And then I also have a new ebook that I just put up there. It's called Keep More, Grow More, the Tax Smart Guide to Profiting from the 2025 One Big Beautiful Bill. That's what OBBB, if you see it, out on the internet and stuff, it's being called the OBBB, One Big Beautiful Bill. That is also there as well. And I don't remember. And here's the webinar link if you don't want to have to go to that site. If you just want to jump on in, an hour or so, or there's the link to it. And I think if you're at all interested in a tax planning session with me, you can just text this number and my team will get back to you on scheduling and what that looks like. I mean, because it's a lot of information. How does it really apply to you? I mean, because most of it applies to everybody if it's done the right way and what your situation is. Just like I say a lot of times, we all have a fingerprint. It's a little bit different. We all have a tax situation and it's a little bit different, right? We all have one, just different. And I think that might be, and here's just some other ways to get in touch with me, some of my social platform stuff. But basically, if you just go to Deborah Daniels CPA or Deborah Daniels CPA, I don't think that Facebook one is right. I think it's Deborah Daniels CPA on everything. And now it's question and answer. So I'm going to stop the share so that I can see people when they ask. But hopefully that wasn't a fire hose. I mean, I could go on and on and on and on, but I feel like those were some key points that certainly everybody got something that they can put their teeth into on that.
I totally agree with you. That was amazing, Deborah. I've got to tell you, I loved your conclusion here about everybody has a fingerprint, and then everybody's tax situation is also unique and different, just like their fingerprint. So, let's go ahead and open it up for Q&A. I know it was a lot of information. I know I personally took a lot of screenshots. I also love one of the image where one of your slides was all about our money leaks, right? I mean, there must have been at least 15 money leaks there for all of us to really take a look at. Our money leaks in our own personal situations and business situations. So I'm going to ask everyone to go ahead and unmic and go ahead and open up your video screen. And we're going to open this up for Q&A. This is your opportunity to get your answers to your questions. And I know you covered a lot.
Right. It felt a little bit, I mean, to me, I'm thinking to myself, I'm like, this is a lot. I mean, I talk about it all day long, every day, so it doesn't feel that much to me, but I'm thinking, hopefully this isn't like too much.
Well, it was a lot for me, Deborah, and that's okay, because I'm going to come back and listen to it again. But I appreciate how you look at it from a very positive vein. I think that's really important. Like how you talked about not doing budget as much as a money plan. And I think that just changed the mindset and changes the energy around it. And I appreciate the idea of it's there, go for it, And one question that I did have is when you use, I was talking to one accountant, and he said, don't write your home off, because they'll come after you on it. It'll just be when you go to move and when you go to do this, it'll be a real pain and all that. Can you give me any clarity?
Sure. And that's kind of an old it's an old-fashioned take on it, really.
Mhm.
What he's talking about is if you do business use of home, um, there's a couple ways to do it. Let's just use real easy math for me because I mean I got my calculator. I used to be really good at doing math in my head, but once you start using the calculator, you're like, oh, I don't remember. But so your house is 3,000 square feet, and your business room, your office room is 300. That's 10%. So if you take 10% of your utilities, 10% of your insurance, 10% of your mortgage interest, and then you also can depreciate 10% of your house. That's what he's referring to. If you depreciate it, you also have to recapture that potentially in when you sell your house. But there is a way around it, and most of my clients are using that instead. They have a standard $5 a square foot up to 300 square feet, which is $1,500. You don't have any recapture when you do that at all. Plus, I mean, it gets even more complicated on business of home. So if I'm an S Corp, I do have a building where I go every day, so I don't do business use of home. But if I did, I could actually do business use of home, but you can't take that standard as a S Corp owner. But you can, and this is something we help clients with, have an accountable plan where it basically I have a template for it. It says, hey, I'm going to write off a portion of my house, blah, 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 blah. And then I submit an expense report to my company every month or every quarter at least. And then I reimburse myself. Same thing gets to happen, but and you don't run into some of those issues as well. But help business use of home. I mean, this guy might have probably my age. I mean, 60 or more. There was a point when business use of home was like a no. I mean, it was kind of like an audit flag, but that was 20 years ago, 25 years ago. I mean,
Okay.
it's not, I mean, you deserve it if you're using it, your home for your business, and you should take it for sure.
All right, cool. All right. And that's really if you actually have the literal office in your home.
Exactly. I mean, but the thing is, I mean, dot the I's and cross the T's. I'm saying that this room, this is my office, my conference room, but this room is 150 square feet. You're not technically supposed to have a TV in there or anything personal or do your crafting in there and all that kind of stuff. But reality check, they're not coming and looking at our room to see if it's, any personal things. And we will have some notice before the IRS auditor comes and we could clear it all out.
Okay, that helps. Thank you
I
very
did not
much.
tell you to lie.
Well, Marie, Amanda, Sarah, do either of you have any questions that you'd like to ask while we've got Deborah Daniel on the line here? I know it was a lot of information. There were a lot of eye openers for me. I mean, you covered everything, the whole gamut from the OBBB and all the new deductions and yeah, there was a lot that it was just a lot of information. So yeah.
It's a fairly simple yet complicated topic. I mean, the concepts are know the rules, figure out the rules, document what you need to document, and keep yourself bulletproof. I mean, but just like the home office, don't believe kind of the urban myths that are out there that, one, I mean, I'm not saying people don't get audited, but I've been doing this for over 3 decades. I've had less than 10 people actually audited where they had to like open up their books and say, what's in telephone? What's in this? It's really more of a scare tactic than a real tactic. But I want to make sure that if you use a strategy, you have that checklist, you have the documents that you need so that if you are unlucky number 11, you're going to pass by that audit, no change. But the reality is it's more of a scare tactic than a reality. And so as long as you CYA, I think and we know what that means. Do the CYA as we go. I think we should be taking advantage of every single piece of the tax law that's out there.
Fantastic. All right. Well, thank you so much, Deborah. We so appreciate you hosting this fabulous mini masterclass series today. Let the IRS fund your business and your life. You really covered all aspects of the big, beautiful plan. So yeah, thank you so much for your time, sharing your expertise. We will share this on our YouTube channel. I'll make sure everybody gets a copy of the replay because there's a lot of information. And please visit beautifulfacesgoingplaces.com often because we have all kinds of upcoming events online and in person, different ways for you as a woman in business, small business owner, entrepreneur to plug into our platform so that you can gain visibility, education, connections, and yes, lots of fun here. And let's grow together. Thank you guys so much. All right, have an amazing day.
All right, thank you so much.
A happy.
Thank you, Deborah.
Thank you, ladies.
Thank you.
Bye-bye.
Carol.
Thank you.
Take care,
Bye.
everyone. Bye-bye.
Bye.